Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Thursday. It's February 24th, and the Dow is down over 800 points. Ukraine is under attack. Now, I do want you guys to remember something important. Typically, during these periods when war is announced, these are typically market lows. Markets typically rally after these sessions. So most of the downside, I believe, is priced into the market. Also, and this is really, really important, if you look at the bond market is up quite a bit. It's up near the 139, 140 level. That's also telling us that there's a flight to safety right now, which means we have the GDP today, and the GDP may be less instrumental in making the Fed's decision of whether to raise rates or hold steady. Typically, the Fed doesn't raise rates or make any kind of federal decisions during times of crisis. So even if the consensus, even if we're at the consensus, which I don't think we will be, but even if we're at or higher on the consensus, I think the Fed will not use that as a factor to raise prices or to raise yield on interest rates. So I don't think that's going to happen. Keep your eye on the bond market. It's very influential. If the bond market keeps going higher, that means there's a higher threat of war. If the bond market keeps going lower, that means most of the action is priced into the market. And I think we're going to go a little bit higher, but then I think we're going to fold. I don't think these prices are going to remain. Typically, when we invade, that's when the market prices in the worst case scenario. And I think right now the worst case scenario is priced in. So, or thereabouts. I mean, we can go a little bit higher, but I think for the most part, we're done with this, with most of it. I mean, take a look at the QQQ right now. Look at this, just to give you an idea. We went from 408 to 319, and I don't know if we're going to go lower than that. That's a fairly good bottom at this point. That puts the level of stocks on momentum level. Let me just show you. At 10%, and that's the lowest momentum levels I've seen in quite some time. Let me show you this. So I think we are literally there right now. This is the same level we've had at COVID. So I don't think the market has much more downside to go. We may be not there quite yet. We may not have another couple of days of gyrations, a little more volatility. But I think for the most part, the worst is there, or maybe another few days almost behind us. So we got to be very careful, but we got to be patient and start taking advantage of these opportunities, which we will do today in our various programs. Now, the volatility levels, if you look at the volatilities, we're right where we were beginning of this month when we had our first mini crash, but we're not really higher. And I actually think volatility is close to peaking out, and I think we're actually going to be going lower. So shorting volatility at these levels may not be the worst case scenario, especially in light of what I'm seeing right now. You could do that by taking advantage of VXX. Because again, these volatility levels are typically not sustainable too much. And as you can see here, every time we go up, and we're up 10% this morning, we typically come back down. And you can buy puts on that as well. Now let's talk about global economy a little bit, and then we'll get into the overall market sector. Stocks plunged and oil prices surged by more than $8 per barrel. They're at $100 a barrel. Do you guys remember what I told you guys about a year ago? That oil is going to go to about $100 a barrel. We're at $100 a barrel. After Russian President Vladimir Putin launched a military action in Ukraine, prompting Washington and Europe to vow sanctions on Moscow that may roil the global economy. We're there already, folks. We're there. Most of it is already priced in. Market benchmarks in Europe and Asia fell by more than 4% as traders tried to figure out how large Putin's incursion would be and the scale of Western retaliation. Crude oil jumped about $100 a barrel in London for the first time since 2014. I told you it would. Ruble sank 7.5% against the dollar. Putin's not doing himself any favors in the long term with this. I'm kind of surprised that he's taking action. Futures on Wall Street were off by more than 2%, and that was on top of yesterday's 1.8% slide to an 8-month low after Kremlin said rebels in eastern Ukraine have asked for military assistance. Moscow has sent soldiers to some rebel-held areas for recognizing them as independent. Putin said Putin's been a bad boy. He's been lying. Putin said Russia has to protect civilians in Eastern Europe, a claim Washington had predicted it would make to justify an invasion. Come on, Putin. People have the internet. They could see global news. They know you're full of it. President Biden announced the attack is unprovoked and unjustified, and boy, his ratings are going to go down so much after this, and said Moscow would be held accountable, which many took to mean Washington and its allies would impose additional sanctions. Yes, as we could see, these sanctions are really controlling Putin. Yes, these sanctions. Come on, man. This is a hardcore KGB guy. Sanctions are not going to do it. This guy knows about the Cold War. Putin accused him of ignoring Russia's demand to prevent Ukraine from joining NATO and to offer Moscow security guarantees, which I don't think are coming. As I mentioned, $100 a barrel per gallon of oil. I don't think it's going to stay there. I think oil is topping out at these levels. Investors were also uneasy about the possible impact of Federal Reserve's plan to try to cool inflation by withdrawing ultra-low interest rates and other stimulus that boosted share price. And that's why the bond market is actually so much higher. Let me just go back to the bond market, as you could see here. Folks, I think most of what we're seeing is overdone. I think it's way, way overdone, and I think the bond market is going to cool off to the downside. I think stocks are going to go higher, but we've got to be defensive. We're right here right now. I think stocks are going to go up, but we may kind of we may trickle for a couple of days. I'd like to see the gap to start getting filled. Till we get filled, no soup. Looking at QQQ right now, also we're down, but again, look at these RSI levels. I mean, look at this. Look at the divergence we're having here. You got to see this. Oops. Look at that. That's massive divergence. That's unsustainable. The odds are this gap is going to get filled. And when it gets filled, the market's going to rally. I don't think this war is going to be very, very sustainable. So I would be taking positions right now against the current trends. In other words, I would be going higher on stocks. I would be going lower on volatility. I would be bearish on bonds right now because I don't think there's going to be a lot more of this volatility till there's a resolution. And typically, these invasions don't last more than a couple of days. Now, today is Thursday, and I want to give you my top ETF. This is actually an ETF we're in right now in our either alpha or global trends. And as you could see here, we're pulling back, and I think we're going to go higher on the carbon. And you can even get on the options here. They're not crazy liquid, but there's some liquidity. You can go all the way to July, and you can go to the 56 strike price. There's liquidity right here. Or you can go to, no, I wouldn't do that one. I would go to July, definitely go to July, and maybe get to the 54-ish, 55-ish, 56-ish. There's some liquidity here. There's some volatility here, and there's an open interest, actually. So you can work these orders. But I think while the world, I think after this heats, after the cool-off happens and after everything resumes back, I think this is going to go higher. But I don't think this rally is going to be all that sustainable. But we never know, and war is unforeseeable. But historically, typically when we attack or when there's an attack, that's the bottom, and usually stocks go higher. But folks, we got to be prepared for volatility, right? We got to be prepared. Volatility continues to dominate the stock market, sinking due to potential interest rate hikes and the ongoing Ukraine-Russia conflict. Most people feel lost trying to predict the market's next move. But Joy of the Trades, Jeff Zananeri, he spotted some huge opportunities and chaos, including 363% win on DGX with a recent play. He went live yesterday to talk about this next prediction, and he wanted to share it with anyone unable to watch the live event. You got to check this out. This guy's been really predicting what's going on with the market with a very high degree of accuracy. It's all about volatility. You need to take advantage of it. Click the link below to watch the broadcast and learn about the biggest prediction of Jeff's career. Follow the link below. Check it out. You don't want to miss this. And tomorrow we're going to do a market recap. Pay attention today. It's not going to be as pertinent, but pay attention to the GDP report. If the number is below 7, it's going to give a Fed even more out. It's happening in about 29 minutes. It's going to give the Fed more out not to raise rates. And the bond market would go higher instead of lower, especially in light of what we're seeing right now. Folks, I hope that helps. Follow the link below. And again, usually when there's an attack during war, That's the bottom, right at the bottom. Historically, that's the case. So I'm actually becoming a lot more bullish right now on stocks and bearish on commodity style assets because the worst, I believe, is close to being behind us. Follow the link, learn, hear what Jeff has to say, and I'll talk to you guys later. Bye, guys.